Most people think investing is for people who already have money. You need a financial advisor. You need thousands of dollars to start. You need to understand the stock market, read earnings reports, pick the right stocks at the right time. None of that is true. And the belief that it is true is costing a lot of people years of compounding growth they'll never get back. In this video, I'm going to show you how to start investing with $500, what to actually put your money in, and why starting now, even with a small amount, matters more than anything else. Here's what we're covering. First, the single most important concept in investing that determines whether you build wealth or stay stuck. Second, what you should actually invest in as a beginner, and it's simpler than you think. Third, where to open an account and how to do it in under 15 minutes. And fourth, the biggest mistake beginners make that kills their returns before they even start. If you've been following this series, your debt is shrinking and your emergency fund is built. Now it's time to make your money work for you instead of the other way around. Let's go. The concept is compound interest. You've probably heard of it, but most people don't feel it viscerally enough to understand why starting at 30 instead of 40 is worth hundreds of thousands of dollars. Here's the math. You invest $500 today and add $200 a month at a 7% average annual return, which is the historical average of the U.S. stock market after inflation. Here's what happens. After 10 years, approximately $34,000. After 20 years, approximately $104,000. After 30 years, approximately $243,000. You contributed about $72,500 of your own money over 30 years. The other $170,000 came from doing nothing, just letting compound interest work. Now here's why starting now matters more than the amount. If you wait 10 years before starting that same $200 per month investment, your 30-year total drops from $243,000 to roughly $104,000. A 10-year delay cost you $139,000. Time is the most valuable resource in investing. Not stock picks, not market timing, not financial advisors. Time. Here's the advice most beginners need, and almost nobody gives them clearly. Buy index funds and leave them alone. An index fund is a single investment that automatically holds hundreds or thousands of stocks at once. When you buy one share of an S&P 500 index fund, you own a tiny piece of all 500 of the largest companies in America. Apple, Microsoft, Amazon, Google, and 496 others. One purchase, instant diversification. The most recommended for beginners are VOO, Vanguard S&P 500 ET, FVTI, Vanguard Total Stock Market ET, FFX, AIX, Fidelity S&P 500 Index Fund. Any of these three will do. They're not dramatically different. The most important thing is picking one and starting, not spending 3 weeks researching which is marginally better. Why index funds over picking individual stocks? Because 80% of professional fund managers, people who do this full-time, fail to beat the S&P 500 index over a 15-year period. If they can't do it, you and I are not going to consistently do it either. The index wins by default because it's the entire market, not a bet on one corner of it. You need a brokerage account to buy investments. 3 beginner-friendly options. Fidelity. No fees, no minimums. Excellent interface. Strong educational resources. Best overall for beginners. Charles Schwab. Similar to Fidelity. Excellent customer service. No minimums. Vanguard. The home of index fund investing. Slightly clunkier interface, but deeply aligned with the long-term passive investing philosophy. All 3 are free to open, SIPC insured, and let you start with as little as $1. For Canadians, there is Wealthsimple and Questrade, all free to use. Opening an account takes about 15 minutes online. You'll need your Social Security number, a bank account to link for transfers, and an ID. Once open, transfer your starting amount, search the ticker symbol for your chosen fund, and place a buy order. That's it. You're an investor. One important distinction: if your employer offers a 401k with a match, contribute to that first. up to the full match before opening a personal brokerage account. As we mentioned in the debt video, an employer match is an immediate 50 to 100% return on your money. Nothing in the market beats that. Capture the full match first, then invest anything additional in a personal account or Roth IRA, which is exactly what the next video covers. The number one thing that kills beginner investor returns is not picking the wrong stocks. It's panic selling. The market goes down, sometimes 10%, sometimes 30%, sometimes 50% in a severe crash. It always feels different in the moment. Like this time it won't recover, like the world is actually ending, like you need to get your money out before it disappears entirely. People who sell when the market drops lock in their losses and then miss the recovery. The market has recovered from every single crash in history, every one. The people who stayed, invested, recovered fully. The people who sold did not. The antidote to panic selling is understanding what you own before you invest. You own pieces of real companies that make real products and services. A market crash doesn't make those companies worthless. It makes their shares temporarily cheaper. Every crash in history has been a buying opportunity in hindsight. The practical tool against panic selling is automation. Set up automatic monthly contributions to your index fund, even $50 or $100, so investing happens regardless of what the market is doing. When the market is down, your automatic purchase buys more shares at a lower price. This is called dollar cost averaging, and it removes emotion from the equation entirely. Go back to your 50, 30, 20 budget. The 20% savings bucket now has 3 potential destinations: emergency fund, debt payoff, and investing. Here's a simple priority order. Priority 1, capture your full employer 401k match. Always, no exceptions. Priority 2, fully fund your emergency fund. Priority 3, pay off high-interest debt above 7% interest rate. Priority 4, invest the rest. Why 7% as the debt threshold? Because the historical average market return is around 7% after inflation. Paying off a debt at 8% interest is a guaranteed 8% return on that money. Investing instead only gives you an average 7%, and averages aren't guaranteed. So high-interest debt comes first. For debt below 7% and student loans in the 4 to 5% range, for example, the math actually favors investing over aggressive payoff. The market's expected return exceeds the loan's interest rate, so your money works harder invested than it does eliminating cheap debt. As a beginner with $500, invest it in your chosen index fund. Set up even a $50 monthly automatic contribution and increase that amount every time your income increases or a debt gets paid off. The habit matters more than the amount. The amount grows over time. Let's bring it together. Compound interest is the foundation. Time in the market is more valuable than the amount you start with. A 10-year delay costs you more than you'd expect. Buy index funds, VOO, VTI, or FXAIX. One fund, instant diversification, no stock picking required. Open a free account at Fidelity, Schwab, or Vanguard. Takes 15 minutes. Don't panic sell. The market will crash. Stay invested. Automate your contributions so emotion doesn't make your decisions. Follow the priority order. Match first, emergency fund second, high interest debt third, then invest the rest. Please subscribe. New video every week. Next week, we're going deeper on one specific account that every millennial should have, the Roth IRA. It's one of the best tax advantages available to regular people, and most people either don't have one or don't understand how it works. That one's next. See you then.